So, good evening, investors. I think one more event from HDFC Securities side for our investors who we try to engage with them on a regular basis and try to communicate with them effectively in terms of their requirement. I think we decided this time in one more webinar to bring a very known personality from the mutual fund industry who doesn't need a introduction. I think I would like to welcome all our investors and Mr. Vetri Subramaniam, who is sitting on the right side, who's a group president and head equity of UT Asset Management Company. Welcome to HDFC Securities webinar, Vetri. It's a pleasure to have you here. I think this is almost 8th webinar series which we have conducted for our investors. I think my marketing team just indicated that we have crossed more than 4,000, 5,000 investors who are logged in to hear from you. You know, the market is so well that I'm not going to talk about the markets. That I'm very clear. I'm going to leave that job to you, which you are good at it. I think the investors mindset has certainly had taken the paradigm shift. The conviction in the market has gone up significantly. The retail contribution, retail penetration has gone up significantly, which is very evident from the SIP book size and the inflow in the mutual fund industry, which is very evident with you. So I'm going to stop there, and I'm going to leave the audience to hear from you what exactly you need to your audiences or our audiences to hear in terms of the market perspective, in terms of UT Asset Management Company's view on the markets, and you can seriously highlight them or throw some light on specifically about your schemes, and we would seriously want to hear our investors your asset management company's view on the markets. Over to you, Vetri.
Thank you very much, Sampath, for this opportunity to host me here at HDFC Securities, and great to be able to reach out to a large number of investors through this medium. So yeah, I'll be happy to share my thoughts in general on what we at UTI think about the economy and about the markets. So without any further ado, if I were to just jump into it, I've been sort of professionally managing money now for almost about 25 years experience in the market. And when I look at I think the economy at this point of time, what I find I think most remarkable is really the very stable macroeconomic platform that the economy currently enjoys. And when I say stable macroeconomic platform, this relates to various factors that we would typically look at, whether it is things like the fiscal deficit, whether it is the current account deficit, whether it is your inflation, whether it is interest rates. All of these are very much in what we would call a comfort zone. These are the kind of stable numbers that you would like baked into your base, so that from this base you can then see a strong acceleration in terms of growth. So it has taken some time for all of these parameters to fall into place. I don't need to remind some of you that if you go back to 2012, 2013, at that point of time the current account deficit was north of 5%. You had interest rates where the 10-year bond was closer to 8.5%. Consumer price inflation was 9%. The current account deficit was in running at almost close to 5%, and there were fears about a complete collapse in the currency, and India actually had been categorized among what a lot of global commentators had started calling the fragile five. And if you remember, in July, August of 2013, there was a very sharp fall in the value of the rupee. So certainly from that point in 2013, if you fast forward to today, there's been a very remarkable transformation in the health of the economy. And obviously, a lot of that optimism related to the health of the economy, the potential that from here we can go for a much better level of growth, that corporate profits will look better, all of that has seeped into the marketplace. So again, from August 2013 to today, if you look at the level of some of the broader indices, they have almost doubled. Right, so we've seen a doubling in the value of the broader indices, and obviously at the stock level, there will always be very dramatic moves related to a doubling in the value of the market itself. So I think that's really sort of the context of what India has enjoyed over the last 4 years. In terms of the stable macroeconomic platform, and therefore a lot more optimism, coming into the equation. I think from here onwards, there are still, challenges in front of us in terms of how do we accelerate from our current level of growth, where GDP is running at about 6 to 7%, to a slightly higher level of growth. And it's not just about the GDP growth number; it's also about, can we create enough jobs? There is the pressure that is coming from technology in terms of job creation. There are other challenges related to job creation, but I'm sure all of you have heard about the context of the demographic dividend in India, and therefore it's very important for us to realize this demographic dividend by making sure that we are able to create jobs in large numbers. That's one of the large challenges in front of us. The other large challenge in front of us is to build a robust infrastructure sector, because if you look around the country, what you will find is that there is still in some senses a shortage of infrastructure capacity within the economy. So I think building the infrastructure of the nation such that it can support much higher growth rates is another significant challenge that the economy is currently faced with. Also, when you look at an economy like India, in the stage that it is in terms of its growth cycle, typically economies like India have used exports. Whenever we have looked at global comparables or other examples, they have used exports to be able to accelerate their growth very dramatically, and lift millions out of poverty, create jobs for a lot of the young people. That again is proving to be a bit of a challenge right now, because the overall global economy is still sort of blow hot, blow cold. It's not particularly robust, and therefore India is not able to use exports to be able to accelerate that growth. But net, when you look at India, when you look at a comparison of where does India stand compared to other emerging markets, and certainly where does India stand compared to a lot of developed markets, we are positioned very, very favorably in terms of our ability to accelerate to a much higher level of growth. I think over the last 3 to 4 years, as stock prices have gone up, obviously a lot of that optimism and expectation that these higher growth rates are going to come through has fed into stock prices. So when you move from thinking about the economy to thinking about the markets, the most critical issue really is what is the health of earnings within the corporate sector, because eventually stock markets, we can look at various things. You can look at GDP, you can look at all the economic variables that you want, but eventually there is only one fuel which can drive stock markets over the longer term. And in fact, if you look at the best correlation between any variable and the stock market performance in aggregate, typically it is corporate earnings, because eventually markets are nothing but a marketplace for corporate earnings, and that is what eventually gets reflected in stock prices. Here I would say the last 4 years have not been very great in terms of corporate profit growth. If you look at aggregate corporate profit growth, it's been running at barely 4 to 5%. But if you look at the economy in terms of our positioning, there's every reason to believe that over the next few years there could be an acceleration in corporate profits over the next few years. But exactly the timing of that, when it might happen, how it will happen, is always a little bit of an unknown. And this is always a challenge in the markets, because there is no such thing as 100% certainty about the future. There is always an element of risk involved in terms of what happens in the future, but certainly the ingredients required to drive earnings growth are already visible. What are those ingredients? In general, you have a low level of capacity utilization. Secondly, interest rates have come off a significant peak, which means that the interest cost for companies has dropped considerably. Companies are deleveraging, which means that they are reducing the amount of debt on their balance sheets. So when you think about a classic P&L account, as you see corporate utilization rates of capacity go up, you would typically tend to see margins in the company start to expand. If interest rates are lower, interest costs also are lower, and the amount of debt is also lower, then the pass-through of operating profits to profit after tax, which is the earnings that we are most interested in, also becomes that much more powerful. So all the ingredients for a faster earnings and growth are in position. But at this point of time, I think, nobody has 100% visibility or certainty to tell you that it's going to happen this quarter or it's going to happen next quarter. And that's the omnipresent risk that, one as an investor in the stock market will always have to deal with. Finally, from my perspective, when I look at equity markets and when I've, invested in the markets for, as I said, close to 25 years now, eventually you need some kind of a mechanism for you to judge what are you paying for that corporate profits. If you look at a 24, 25-year period, then the long-term corporate profit growth for, let's say, the Sensex is running at about a 12% rate from 1994 to 2017. The index performance of the Sensex is also running at about 12% per annum over that entire 20-odd year period. So there's a reasonable amount of correlation over the longer term, but as I said, in shorter periods of time, these two can diverge. So I think the challenge right now for us as equity fund managers is that a lot of the good news has filtered into stock prices. So honestly, it's very difficult to call the stock market as being cheap anymore. It's certainly a market which is, by some senses, slightly rich in terms of valuations. It is not as cheap as it used to be, let's say, in August of 2013. If I go back to August of 2013, the markets were trading more like 15 times on a trailing basis. Today, the markets are trading 23 times on a trailing basis. Now, eventually, the stock market is nothing but a market of individual stocks, and you can look and slice at this data different ways. But if we want to take a general pulse reading of the market, then looking at what you are paying for corporate earnings in aggregate is a useful benchmark. And by that measure, we are now in territory which, as I said, makes being a fund manager very challenging, because there's nothing which is particularly cheap when you look at it from a valuation perspective. So I think that is the one sort of valuations which I would say that we need to sort of be a little bit cautious about what our future returns from the markets can be. To simplify this, and there's a lot of academic theory about this, but I don't want to bore you with that. To simplify it, in a way, higher valuations mean lower forward returns, and lower valuations mean higher forward returns. Equally, my experience, in the markets over 24, 25 years has broadly taught me one thing. When the news is really bad, valuations are very cheap, the perception of risk tends to be very, very high. But the actual level of risk is actually much lower. The opposite is also true, which is that when the news is very good, when all your economic data looks great, your country's fundamentals look fantastic, your stock market is no longer trading at a discount to its long-term average, is now trading at a premium to the long-term average, is trading at a premium to other markets, then at that point of time, the perceived risk is very low, but the actual risk actually sometimes ends up being slightly higher. So I think that's the perspective that I would bring to the table, which is to say that if you're investing in an Indian market, in equities, looking at a 10-year, 15-year period, then the strength of the underlying platform will most probably see you through. But don't ignore that there is some level of valuation risk to this market. And I always get asked the question, what are the risks? What can cause the market to come down? And the honest answer to this, and this has been true for the last 24 years, 25 years of my career, is that you never know beforehand what are the risks that will eventually cause the market to change the valuation level that it is comfortable with. Eventually, valuations are not science. They are a reflection of the collective confidence of investors like yourself, those of you on this call, millions of investors around the country who are not on this call, and a few thousand investors sitting outside this country as well, because they own 20% of all stocks listed in India. So valuations are nothing to do with science, it's got to do with confidence, and anything which shakes confidence will have an impact on valuations. So that is something that I would urge you to remember when you are thinking about investing in this market. But again, if you're willing to look over a much longer time frame, you're saying that I'm very delighted to see that Indian investors are now coming in through the SIP route. They talk about doing SIPs for 5 years and 10 years. And if that be the case, it's actually a wonderful thing, because now you're looking beyond the volatility which can be caused in the short term in the stock market. Just yesterday I was talking to a group of investors, Sampath, and actually not investors, actually students, and they were asking me the same question about valuations. And I was just talking to them about one of UTI's oldest schemes, which is the UTI Master Share. And if you go back to July of 2007, when again the market was not particularly cheap, it was like, by any definition, it was actually rich. It was comparable to today's valuations, or maybe just marginally lower. If you had invested in that scheme at that point of time, fast forward to today, over 10 years, your returns are almost about 13-14% CAGR over that period, which is a healthy rate of return when you're looking at equities over a 10-year period. But the only point that I would make to you is, keep in mind that the first 4 to 5 years after making that investment may have been slightly painful, because nothing much happened in the first 4 to 5 years. Because equities are not like a fixed deposit that every year you will add 7% or 10% or 15%. The returns can be front loaded, they can be back ended, there can be years in the middle where you feel like you're in the desert. So that's the mental perspective that eventually I think all equity investors need to sort of develop. And understand how to deal with periods where equities can be a frustrating asset class, where you can have quotational losses on your portfolio. But if you've got a good portfolio and you're willing to ride out that longer time frames, or time frames where nothing much happens, eventually you can get returns. And I think this 10-year perspective of what people in MasterShare have earned, despite the first 4-5 years being challenging, is actually a good example of how to earn your returns in the equity market. And therefore, it's always been said, and I think this is very true, that in the equity market, and these students were asking me as well yesterday, that what should we study, what should we read, how should we become better investors? And I gave them all the regular examples on the books that they could read, the blogs that they could read, and there's so much wonderful information that is available over there. But what I also told them is that if you go back and look at what one of the most famous investors in the world, Mr. Warren Buffett, has said, he's actually said that investing is not about IQ. It's actually about EQ. It's actually about emotional quotient.
Absolutely.
It's the ability to take punishment at different points of time and wait for gratification in terms of reward at a subsequent point of time. So I think if there's anything that investors need to learn, it's more about the EQ rather than the IQ. I think the basic level of IQ required for the stock market honestly is not very high. It's more about the EQ. So that's what I would say in that context. Moving on from that, I just thought, since I'm here, it may be useful to talk to you about one of the schemes that I manage directly at UTI, which is the UTI Opportunities Fund. This has been sort of a flagship fund for UTI for many years. It's got a great track record over the last 10-15 years. The last 2 years have been a bit of a challenge for the UTI Opportunities Fund. It was very large cap dominated. The positioning wasn't very acute. I took charge of the fund in February of this year, and so it's been about 4 or 5 months working on that fund. We've now repositioned that fund, keeping in mind the long-term perspective of how that fund has been managed, which is that it is a blend of both large cap and mid cap stocks in the portfolio. If I were to just sum up the thought process for this portfolio in a very simple manner, and again, this is based on my own sort of experience in the markets over long years, is that most things in the markets and most companies tend to have cycles, right? So only thing is, you don't know how long the cycle is. Does that mean that everything is cyclical? It most probably is. But again, the length of the cycle is an unknown. Now, the way we deal with the fact that the length of the cycle is unknown in the Opportunities Fund is to actually invest at what I would call two ends of a barbell. Right? At one end, we look to invest in companies which actually defy the cycle, which means their growth rates, their financial metrics have tended to stay significantly above average, significantly ahead of industry numbers for long periods of time, because they have a certain set of comparative advantages that allow them to do this. So we are very happy to invest in those kind of companies. At the other end, we also have companies which in a sense have fallen what I would call as a victim to the cycle. It could be because of economy reasons, it could be because of sector specific reasons, it could be due to the actions and strategies of the management of the company itself. But because they have fallen victim to the cycle, very often this is an opportunity, because if things turn around for them, if our research leads us to believe that things may be on an improving trajectory, you also very often get to buy these companies at very cheap valuations, and if you get it right, then eventually you get the benefit of a turnaround in the business, but also an improvement in the valuation metrics. Whereas in the first set of companies that I described to you, which I would broadly call as outliers, you typically have to buy them expensive. They're never available very, very cheap. But you can make up for that because they tend to compound in terms of compounding their earnings at a much, much higher rate than the broad market. So the thought process for the opportunities fund is really to extract value from opportunities at the two ends of this spectrum, and that's what we call it. The portfolio looks more like a barbell because it is heavy at the two ends. So that's the thought process for the opportunities fund in terms of stock picking. It's also a fund where we take a lot of sector risks. So if there are some sectors we feel more positive about, we would be willing to be overweight there. If we don't like something, we're willing to be underweight. This could be based on growth, it could be based on valuations. But essentially we do take what we call active risk on sectors. We are not like some other funds in the market are. They run on a sector neutral basis. We actually run with an active sector approach as far as the opportunities fund is concerned. So this is actually the thought process for the opportunities fund. I have sort of changed the portfolio in the months of March, April, and May, because it's a large fund, 4,000 to 500 crores. So it took some time to realign the portfolio, but I think we're quite happy with the way the portfolio is positioned today to benefit from companies which are either defying the circle or could be beneficiaries of a change in the cycle. And I would urge you to sort of look at some of the information related to that fund and consider it. So maybe I'll just pause at this point, Sampath, because I understand we have some questions.
Sure, Vetri. Yeah,
we can
certainly take that. I think, thank you, Vetri. I think 25 years of wisdom, I would call. It's nice to hear that reflects what exactly the retail investors were thinking about. I think you rightly touched upon what is ringing today in retail investors' mind is, is it the right time? Which time and again they have been asking us, whether when the Nifty touched 6,000, they said that, is it high? Can I enter or not? And then when it crossed 7,500, then the question again came. Then today we are sitting in almost 10,000. The question reflects the same retail investors' attitude towards the market. I think you did mention what is still ringing in my mind, since now that I'm sitting very close to you. I think the valuations has certainly something which you need cautious. That I'm sure retail investors would have taken it in the right spirit. The approach, what the retail investors at this point of time, they might have made a mistake of not entering at 6.5 or not entering at 7.5. Today, see, one of the guys have asked, he has got some lump sum of 50 lakhs or 70 lakhs or 1 crore. Do you think, what do you think we should advise to these? As a distributor, we have this challenge of meeting the client's requirement. I think, what should we, as an investor, if I have to ask, I have 1 crore rupees,
Sure.
At this point of time, what Vetri would you suggest?
No, sure, that's an excellent question, Sampath, and this I think kind of challenge that everybody experiences in terms of how to deploy money. So the simplest solution, if you did not have this problem, I think was to say that if you're earning money on a monthly basis, why not invest it on a monthly basis as well? And therefore, very happy to see the popularity of systematic investment plans today, where people are actually investing on a monthly basis rather than trying to do it all at one go. Because if you just think about the implications of that, what it means is that if you're investing every month over the period of 5 years, 10 years, 15 years and 20 years, you would have ended up buying the market when it is cheap. You would have ended up buying the market when it was reasonably priced. You would also have ended up buying the market when it was expensive. But over time, it all averages out and your eventual cost of acquisition will be somewhere close to average. So basically what you do by the process of SIPs is that you make sure that your average acquisition cost is somewhere close to average valuations. So you minimize the impact that valuations can have on your long-term returns, because now you have entered closer to average valuations, and therefore the outcomes you get will hopefully be related more to whatever happens to earnings, which is something that we can feel positive about in the longer term. Now, challenge that I see very often with investors is that you run into investors who say, I don't own any equity, so now I need to get in, so what do I do? So I think when you are in those kind of situations, again, obviously it's not what we call an SIP, but there is also an STP route available to you, which means that you could put your money first into a liquid fund or some kind of a simple debt accrual fund, and then look to transfer your money over a period of, let's say, 12 months, 18 months, 24 months into a equity scheme. So if you're putting 100 rupees into the liquid fund or debt fund, you could transfer 4 rupees every month from that 100 into the equity fund. So what that would do is basically ensure that the money is invested over time rather than all at one go. I would also add to that once you have started such a plan, and you would most probably start that plan today, because that would be a better way to do it rather than try to put the entire 100 rupees at one go and open yourself up to significant valuation risk taken at a point of time. So you can overcome that by doing the STP, but also remember that once you have started the STP, if for whatever set of reasons, 6 months down the road, 12 months down the road, the market comes down very dramatically and it comes down to average valuations, you don't have to continue with that. You can just halt the STP and put the balance money back into the market. So all that the STP does, it gives you that optionality of spreading it out over time.
Yeah.
And if at all something were to happen to cause valuations to correct, I mean, you could have been sitting here in March of 2015, the Nifty was, I think, 9100. You could have said the same thing, what should I do? All-time high. Even at that time, valuations, not as pricey as today, but they were about 20.
About 20.
You could have started a STP, first 7-8 months, market gradually came down, and then suddenly in, Jan, Feb 2016, it came down very sharply. You could have always cancelled the STP and put the balance in. So I would broadly say to those who are looking to invest, like your, customer has asked on that query, best route would be go through a STP. And I would say when you do a STP, 3-4 months doesn't solve the problem. Typically work with at least 12 to 24 month periods, maybe 12 to 18 is more ideal. And then you always have the option of cancelling it and upfronting it immediately if and when a correction were to happen.
When a sharp correction, yeah. Okay. Fine. So, Vetri, I think since you touched upon, and we as a distributor also seeing a lot of traction towards one of your schemes, which you said, UTA Opportunities Fund. We have been seeing some considerable traction towards investors. Maybe they have seen that change in the portfolio, or seen the returns slowly progress, steadily increasing. Could be a combination of anything and everything. And we have been asking the investor, considering the portfolio balancing and all that. We also internal retail research has certainly come out with a reckoner for last 2-3 months carrying UTA Opportunities Fund. I think what is a view I think you need to give to our investors? What's the horizon that they need to look at this particular fund? Could just throw some light on that.
Sure. So I would say when you're looking at any equity fund, and it doesn't matter at which point of time you're looking at it or what kind of fund it is. So not just for the opportunities fund, I think you should be having a minimum investment horizon of at least 3 years. But honestly, given where valuations are, I would say have a perspective of at least 5 years and longer. And I think really if it's about how do I make sure that I have some allocation to equities, because my allocation to equities, and this is the challenge I find with many retail investors, friends and family who are part of my circle, the challenge is that most people just don't have enough exposure to equities. All their exposure is lying in gold, it's lying in real estate, and mostly in bank FDs. So the challenge for them is how do they diversify their portfolio, meaning how do I diversify into equities? So I think, you could use that STP route, as I said earlier, to sort of put it in. But ideally, I would say keep at least a 5-year perspective. And again, why am I saying keep a 5-year perspective? There's a lot of reasons to feel positive about where India is placed today, but there is always that omnipresent risk which comes from valuations. And I said, valuations are not science. Valuations at some level are collective confidence. And nobody can predict with accuracy as to what events in the future can cause collective confidence to either go up or either come down. But what we do know is that it's very much like the pendulum of the clock. It always swings from one extreme to the other. It has always done that for the last 25 years that I have seen in India. All the global history, all the global data also tells you that the pendulum swings. So it's better to realize that it swings and prepare for that rather than presume that this is a one-way street.
Vetri, I think that on the lighter note, the investors always feel fund managers are some kind of magicians. So they keep asking, where do you think Nifty would be hitting? I heard you right, I'm sure. I heard you loud. I'm sure investors also would have heard you loud. So I'm not going to ask you that naive question which is frequently asked, where do you see Nifty to be 2 years down the line or 1 year down the line? So I'm going to avoid that question. But what do you think? I think I also promised you that I'll not ask you anything about stock specific. So I'm sticking on to that. But Can you just throw some light on IT and pharma assess pain? You know, the kind of pain which I don't need to mention. We all are aware, which is running out right now. I think both these sectors. Could you just tell us what exactly, where is it heading to, or
Sure.
what exactly is happening in these sectors?
Yeah, no, I'm happy to give you some perspective on that. See, the two are slightly different. First of all, let me put that in perspective.
They don't go well with the bull market.
No, I mean they're different from each other.
Okay.
See, to be fair, if you actually look at IT, it's, or rather pharma, it's actually the best performing sector of the market even today.
Yeah.
From 2008, just before the crash happened, till today, it's one of the best performing sectors in the market. So when you look at much longer time frames, pharma has been done wonderfully. It's not done well, I would say, pretty much in the last 18 to 24 months. That is where, for the first time, pharma in about 10 years has actually stumbled and stumbled significantly. But I was actually driving more at the difference between IT and pharma, which is that IT is still predominantly an export-oriented sector. 90-95% of their revenue comes from exports. Pharma is actually a very different sector because, first of all, while we use the word pharma, the right word is perhaps healthcare. And within healthcare, a lot of the companies, particularly who are in the services domain, are all domestic. Then you have companies who are pharmaceutical. Right word would be they are the tablet makers, the drug makers. Those companies, again, typically 40 to 60% of their profits actually is local.
Okay.
And it's only the balance which comes from exports. There is no doubt that over the last 4 or 5 years, in fact, I would say going back a decade, the significant driver of profits has actually been their export business. But we should not lose sight of the fact that there is also a strong domestic business. That makes it very different from IT. If you look at pharma, therefore, to begin with, and then we can look at IT. I think in pharma, what we would say is, look, this is a sector which had a great run in terms of profitability. The profits went up dramatically, market cap went up dramatically, valuation also went up dramatically. And therefore, in some senses, is one of those cautionary tales about what happens when valuations run up, and then events happen which cause confidence to fall apart, and then very often you will find that's the same time when the earnings also start to suddenly not show the kind of growth that one has seen in the past. So we've had a series of issues related to deflationary trends in pricing in the US market. We have had quality related issues which have suddenly come to the forefront as far as Indian companies are concerned for their exports to the US. So there's also been correspondingly a damage which has happened to valuations of these companies in the marketplace. But I would think if I look at this from a structural point of view, then I think to the extent that the pharmaceutical sector and particularly the tablet making sector, the drug making guys, still get 40 to 50% of the profits locally, in fact 40 to 60% of their profits locally. That I believe will continue to be a growth industry because sadly, as most countries grow more prosperous, there is also the rise of what we call lifestyle diseases and chronic conditions, cardiac conditions, central nervous systems problems, the rise of cancer, autoimmune diseases, and these require lifelong treatment. And now we have a population whose incomes have gone up, so they can afford to pay for it. So it's unfortunate, it's sad, but therefore to the extent that the pharmaceutical sector actually has a large domestic component to it, I think over time people will see the value in that. The valuation correction has happened, and incrementally we would tend to be more positive about this area, largely because we think the domestic story over there has not changed. What has changed is the prospects in the US market. I will only say one thing as far as the US markets are concerned. It's the most challenging market in the world. The Indian companies have a disproportionate share of that market. The US cannot cut Indian companies out of the system because if they cut us out of the system, 70% of their drug supply stops. So despite all the quality issues, they've continued to work with Indian companies to address them. And we have seen many companies which had quality issues 2 or 3 years ago now get approval and restart their supply to those markets. So I think the quality issues also will eventually get addressed by the better companies, the smarter companies, and that should start. The market today is ignoring the fact that most of these drug making companies are spending anywhere between 7 to 9% of their turnovers on research and development. Okay. Right? And eventually I believe a lot of this spend will convert into their ability to produce complex products, what we call complex generics, and specialty products into export markets, also into other emerging markets which are equally attractive the way India is. Whether it's a Brazil, whether it's a Russia, whether it's a Vietnam, Indian companies are actually leading, producers of drugs for those markets as well. So I think as far as pharmaceutical is concerned, a great part of the valuation damage has happened. very strong domestic business, and eventually there will be some upside that comes through for some of them because of the R&D spends that they are making. So we would tend to believe that longer term, these are some of India's most competitive companies. They've proved themselves globally.
Yes, yes.
So it's not something that we would, sort of dismiss. We do think that over the next few years things will look better for them, driven by domestic, and some of them making a success of the overseas opportunity. IT, as I said, it's predominantly an export-oriented opportunity. The cycles in that industry currently don't seem to be favorable in terms of the growth being slightly slow. But if I look at the evolution of this industry over almost 18, 19 years that we have seen it, what we have seen is that at every stage they have gone through waves. There was one time where they first started with a very simple outsourcing and what they called body shopping process. Then there was this whole Y2K boom which happened. Their business model evolved further. They changed the way they did work. People thought after Y2K the business model would fall apart. Instead they went into the ADM space. Then they ended up going into product implementation and enterprise solution space. People thought again that was now slowing down. It did slow down. In fact, all their base businesses have always slowed down at some point of time. Yeah. They found a new wave and that gave them growth. And why are they able to do this? They are able to do it because India has more people that it can supply to do these jobs than anybody else can. I think they are going once again through a very significant change where the nature of technology spend is going digital, it is going cloud, and all of these changes are happening. The base business is starting to slow down. But if you look through their top line number, what you will see is that there is one base number which is slowing in maybe some of the old traditional practices, but some of the new practices are starting to accelerate. So I believe it's a matter of time before eventually you see a little bit of uptick come into their growth numbers as well. So we would certainly not dismiss these two areas because they are out of favor. I think what is supportive for these two areas is there's been a very significant valuation correction, and particularly in IT. Don't forget that these companies are now saying we are still 40% ROCE companies. We are throwing up a lot of cash. Either we'll give the cash back to you, or we'll use it to do acquisitions and further our prospects. That cash is not insignificant. We were just doing the math the other day in the office. Over a 12-month period, the total dividends and buybacks done by the IT companies will amount to close to 50,000 crores. Okay. That's the size of the SIP pipeline. Yes. Just to put it in perspective. So, to the extent that they are also now following this thought process of saying, use the cash to grow the business or return it, I think it also starts to put some kind of a floor and support on their valuation numbers.
So that's also a glimpse of hope there.
Yeah, I think so. And again, these are companies that have proved time and again that they are India's most globally competitive companies. They have not proved their merits just about competing against other companies in India. They have competed against companies from other geographies in their home markets, and they've proved that they are able to make a success of their business model. So I would tend to give them the benefit of doubt. Difficult conditions come and go, but strong business models with good managements, eventually they figure out how to sail through it.
I think very, very fair, Vetri. I think to summarize whatever you have covered upon, the retail investors were certainly looking about what could go wrong was there in everybody's mind, inching towards the 10,000 mark. Nifty, I think.
So if I can just interrupt you on that,
yeah.
I think the first thing investors should do is stop thinking about stock market levels.
Yes, I think that's fair.
When I started, the market was 3,000. Today it is 32,000.
Yes.
If you are in this market for 10 years or 20 years,
stop looking at those numbers.
Believe me, it will keep making new highs several times during your lifetime.
Yes.
What you should worry about is not levels; it's about valuations.
Yes.
So please differentiate between those two numbers. Is what advice I would give.
I'm very glad. That's why we have seen. I think whether it is the manufacturer, which is the asset management companies, or whether it's distributor, we have been always interacting with the clients. Don't time the market. Don't look at those numbers. Those are numbers which has a process, which is a reflection of various things of economy. That's the numbers, and it does, and it's just an indicator, but it should not be a deciding factor. That is something which we have been time and again communicating to the investor fraternity. I'm very glad you came, took your time from your busy schedule for us and spent almost 40 minutes with our retail investors. I'm sure almost 5,000 investors who have heard you would have been benefited. They would certainly benefit from your words of wisdom, and they would certainly look at UTI schemes, especially UTI Opportunities Fund and others, various schemes which you have been offering. I think one factor which you rightly said, the valuation. Other than that, I don't think there's anything significantly alarming in the market right now, which we all foresee, which we all know about it. So I think we shouldn't time the market. Coming through SIP route should be an ideal way of investment. These are the words from you. We really appreciate you, and on behalf of all our investors and my colleagues out here, I would like to thank you, Vetri, for dropping in and sharing your time and knowledge with all our investors. Thank you so much.
Thank you for the opportunity.
Thank you.